So there's no getting away from taxes. At the end of the day, if you make money in an investment vehicle, you're going to be taxed on it somewhere. The question I have for you is, do you want to pay the tax on the seed or on the harvest? Hi, I'm Antonio Cibella with Vision Wealth Management. Welcome to our latest video, story time. So, an old-time farmer goes into the local feed store. It's the beginning of the season. He's got to buy all of his seed. And he walks up to the counter and he sees a new face. And the guy says, "Hey, I'm the new owner here. Welcome to the store. I know you've been a customer for a long time. Let's go ahead and get you set up." He takes out his order form and the farmer starts to make his order for the season. He gets everything filled out. And he says, "Okay, I think I'm ready to go. This is what I need." And the store owner says, "Well, John," because the farmer's name is John, "Well, John, I got a deal for you. You don't have to pay me anything today for the seed. You just pay me after the harvest. Once you grow your crops, you sell everything, come back and pay me then. Just pay me out of the proceeds from there. Let's call it 20%. You pay me 20% on the backside. You don't have to pay me anything today." And so the farmer, John, takes out a napkin, starts to do a little bit of math, and he says, "Wait a second. That's not a good deal." He figures out pretty quick he's going to pay a lot more if he has to pay on the harvest than on the seed. So he says, "Listen, Billy." Billy's the name of the guy who owns the store. "Listen, Billy, I'm just going to pay for it right now, just like I normally do. I'll just pay for the seed. I'll see you next year." And so he does, and he goes on about his business. Makes perfect sense. Real easy to see in an example like that why you would want to pay up front rather than at the end. But when it comes to retirement planning, often we do exactly the opposite. So we've been told to fund traditional IRAs, to fund 401ks for years and years. You get a great tax deduction when you put the money in. Makes perfect sense, right? You're paying tax on the harvest and not the seed. So let's go through an example. Let's say that you put $50,000 away into a vehicle over a number of years, 401k or a traditional IRA. You've contributed $50,000. Let's say that you're in the 24% tax bracket. If you're married right now, that means that you're in somewhere between around $90,000 to $170,000 of income for the year. A lot of folks fall in that category. So you're in the 24% marginal tax bracket. That means that you successfully avoided paying taxes of $12,000. So if you had $50,000 in income, 24% of that, which is what you would have owed in taxes, you didn't have to pay that money in taxes because you put the $50,000 away. But if you leave the money there for a long period of time, eventually it grows 8.5% over the course of, I think my math was 20 years on this one, 8.5% over 20 years, $255,000 is what the account grows into. Now you've got to pay tax on that whole amount. Now, not all at once. You'll drip it out over the course of your retirement, but inevitably you're going to pay taxes on every dollar that's in there because you got the deduction up front. Had you put the money in a Roth IRA or used a Roth option inside of your 401k plan if your employer allows it, you would have paid $12,000 more in taxes up front, but you'd had $255,000 not to be taxed, tax-free in retirement because you paid up front. In that case, you paid on the seed and not on the harvest. Something interesting to think about. There's a place for both in a retirement plan, but don't overlook the Roth, whether it's a Roth IRA or if you have a 401k option for Roth inside your plan, look at utilizing that. If you have questions about this sort of thing, drop me an email, shoot me a line. Contact information will be up there in a second. Hope you enjoyed the video today. Thanks for sticking around. I hope you learned something, and I'll see you soon.